All right, stop scrolling for a second because something important just happened in silver, and it's not the kind of thing you notice by staring at a price chart. Last week alone, silver collapsed from roughly $121 down to $72 in a matter of days. That's a $49 move that shook out leverage faster than most people could blink. And while everyone was watching that liquidation happen, the US quietly hosted a 50-nation critical minerals ministerial. At the exact same time, Donald Trump advanced a $12 billion strategic minerals stockpile modeled after the Strategic Petroleum Reserve. Both of those just happened, and here's why that matters right now. Stay with me because I'm going to show you what's actually driving this market beneath the noise and how you can spot this setup before it explodes. If you're holding silver right now, you need to understand what just happened. If you're watching from the sidelines, you're about to learn something that most traders never internalize. And if you're actively trading this, the levels I'm about to show you could change how you position for the rest of this week. Now, before I explain what caused that violent drop and rebound, let me teach you something most people never really internalize about silver. Silver isn't just a trade, it's an input. It's used, consumed, locked away in electronics, solar panels, medical devices, defense systems. And unlike stocks or bonds, when silver is gone, it's actually gone. Think of it like oxygen tanks on a submarine. You can trade futures contracts on oxygen all day long, but if the tanks run low, paper doesn't keep you alive. That's the difference between paper markets and physical reality. Most people don't understand that silver trades in two parallel worlds at once, and right now those worlds are moving in opposite directions. Here's what I mean. When you buy a share of stock, you're buying a claim on future earnings. When you buy a bond, you're buying a promise to pay. But when you buy physical silver, you're buying a finite resource that gets used up. Solar panels alone consumed over 140 million ounces last year. That silver doesn't come back. It's embedded in products on rooftops across the world. Electronics consume it. Medical applications consume it, and every single ounce that goes into those applications is essentially removed from the tradable supply. Now, at the same time, there's a paper market, futures contracts, options, ETFs, and that paper market is massive. It's many times larger than the actual physical market. So you've got this situation where the price discovery happens in the paper market, but the actual consumption happens in the physical world. And when those two worlds start to diverge, that's when things get interesting. So, what does that tell us? It tells us that you can't just look at a price chart and think you understand what's happening in silver. You have to watch both markets. You have to watch the futures price, sure, but you also have to watch physical premiums, delivery times, mint availability, and what I call sovereign signals. Those are the hints that governments are moving, and that's exactly what we're seeing right now. If this is making sense so far, drop a comment below and let me know if you've been watching silver or if this is new territory for you. I want to know who's in this room. Now here's what's actually happening. Let me break down the sequence because this is where it gets interesting. The primary driver of last week's crash wasn't some sudden collapse in demand. It wasn't bad economic data. It wasn't China selling. It was margin pressure. And I need you to understand how this works because it's mechanical. It's not emotional. Futures markets are built on leverage. You don't put up the full value of the contract. You put up a fraction, and that fraction is called margin. When volatility spikes, exchanges raise margin requirements to protect themselves. That's automatic. It's a rule. So when silver started slipping, the exchange raised margin. And when they raise margin, traders who are leveraged have to either post more cash or sell their positions. Most don't have extra cash sitting around, so they sell. And when they sell, that pushes the price lower, which triggers more margin calls, which triggers more selling. It feeds on itself. It's a cascade. That's how you get a slam from $121 to $72 that feels engineered, even if no one has to conspire. The system does it automatically. Now let me give you the numbers so you understand the scale. Silver was trading around $117 early last week. By midweek, it had dropped into the mid-80s. By Thursday, it touched $72. That's a 40% decline in about 4 days. And here's the thing. When you see a move like that, your first instinct is to think something fundamentally changed. Maybe demand disappeared. Maybe there's a recession coming. Maybe the thesis is broken. But if you look at the actual data, none of that happened. Industrial demand is still strong. Solar installation forecasts are still up. Defense budgets are still growing. Nothing in the fundamental story changed. What changed was leverage. And leverage doesn't care about fundamentals. Leverage cares about price movement and margin requirements. Now here's the secondary confirmation most people missed, and this is critical. While Western paper markets were puking contracts and traders were getting liquidated, Shanghai physical prices barely blinked. In fact, they kept trading at a $14 to $15 premium over the futures price. Let me say that again. While New York was collapsing, Shanghai was saying, will still pay $14 more per ounce for physical metal. That's not noise. That's physical demand saying, we don't care about your margin call. We need the metal. And here's what's wild about this. At the exact same time this margin liquidation was happening, governments weren't selling. They were buying. Quietly. Locking in supply. When nations start talking about strategic stockpiles, they're not worried about next week's price. They're not worried about whether silver hits 80 or 90 or 100. They're worried about availability. They're worried about whether they can get the metal when they need it. And that tells you something really important about how they view the market. They think supply is going to get tight. They think prices could move in a way that makes accumulation difficult later. So they're moving now while everyone else is panicking. And this is the part that should make you nervous if you're short, or wake you up if you're long. When margin-driven selling collides with sovereign-level accumulation, you get a pressure cooker. Paper price goes down. Physical tightens up. And the spread between the two grows, and that spread is the warning sign, because eventually one of two things has to happen. Either the physical market has to come down to meet the paper price, which means demand has to collapse, or the paper price has to come up to meet physical reality, which means a repricing event. And right now, there's no sign that physical demand is collapsing. So ask yourself this. What happens if paper markets are forced to chase physical reality instead of suppress it? What happens if the traders who sold at $75 or $80 suddenly realize that physical is trading at $95 with a premium? They have to cover. They have to buy back. And if they all try to do that at once, you get a short squeeze on top of the mechanical rebound. That's the setup we're looking at right now. Because here's what's already happened. Silver has already rebounded about 20% from that low. It's back trading around $90 as I'm recording this. And it did that without any real participation from the same leveraged traders who caused the drop. They're still on the sidelines. They're still licking their wounds. They're still trying to figure out if it's safe to get back in. So if silver can move 20% without them, what happens when they come back? Now let me show you why this pattern matters, because this is the exact same playbook we've seen before. Zoom out and you see it clearly. In 2011, silver went through brutal volatility. It hit nearly $50 an ounce in April, then crashed to $26 by September. Everyone said it was over. Everyone said the bubble had popped. But what they didn't see was that physical demand never went away. Mints couldn't keep up with orders. Premiums stayed elevated. And by early 2012, silver had recovered back above $35. The violent pullback wasn't the end of the move. It was a shakeout in the middle of it. Same thing happened in March 2020 during the liquidity crisis. Remember that? Everything was getting sold. Stocks, bonds, commodities, gold, silver. Funds needed cash, so they sold whatever they could. Silver got smashed from $18 down to $12 in a matter of days. But here's what happened next. Mints ran out of product. The US Mint stopped taking orders. Premiums exploded to $4, $5, $6 over spot. You literally couldn't buy physical silver at the paper price. And within 3 months, silver had rocketed back to $20. Within a year, it was at $28. Every time this has happened, paper liquidity breaks first, physical stress follows, and then price snaps to reconcile the two. And it's not just silver. This is a pattern that plays out across commodity markets, whenever you have a disconnect between paper and physical. In 2008, oil futures went negative for the first time in history. Negative. Traders were paying people to take delivery because storage was full and nobody wanted the physical barrels. But did that mean oil demand was dead forever? No. It meant the futures market had a technical problem, and once that resolved, price recovered. When you look at the pattern, it's never the calm periods that matter. It's the moments when markets stop behaving normally. That's when the real opportunities show up. That's when the real risks reveal themselves. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. Silver is volatile. We all know that. Anyone who's traded it or held it knows you can see 10, 15, 20% swings in a matter of days or weeks. So could this just be normal volatility and I'm reading too much into it? Maybe. Could governments talk a lot about strategic stockpiles and then act slowly or not at all? Yes, we've seen that before. Governments love to announce plans and then spend years in committee meetings figuring out how to implement them. Strategic stockpiles don't get built overnight. They require funding, logistics, storage, international coordination. So could this whole minerals stockpile thing just be political theater? It's possible. And let's talk about manipulation claims, because I know some of you are thinking that. Could this drop have been engineered by big players trying to shake out retail? Could banks or institutions be suppressing price to accumulate cheap? Here's the thing, I've heard those theories for years, and while I think there's evidence that large players can influence short-term price action through concentrated selling or spoofing or other tactics, you have to be really careful about turning every market move into a conspiracy. Because if you do that, you stop analyzing and start assuming, and that's dangerous. Here's what I think. You don't need to believe in some grand conspiracy to recognize a structural mismatch. You don't need to think there's a shadowy cabal controlling silver to see that margin mechanics create liquidation cascades. You don't need to believe in manipulation to observe that Shanghai is paying a premium while New York is selling. Those are facts. Those are observable. Focus on what you can control: physical premiums, delivery stress, policy signals, margin requirements. Those are real. Those are measurable. Price alone isn't the whole story, and attributing every move to manipulation is a mental trap that stops you from actually learning how markets work. Could this rally fail? Yes. Could silver go back down to 70 or 60 or 50? It's possible. Could the stockpile plans get canceled or delayed? Sure. But here's what I'm watching. I'm watching whether the mechanics that caused the drop are still in play or if they've resolved. I'm watching whether physical demand stays strong or starts to crack. I'm watching whether governments follow through or just talk. And I'm doing that without needing to be certain, because in markets, you're never certain. You're just evaluating probabilities. There are probably 3 types of people watching this right now. Let me speak to each of you directly. The first type already owns silver and feels whiplash. Maybe you bought at 110 or 115 and watched it drop to 70. Maybe you're still holding and wondering if you made a mistake. If that's you, let me say this. Your frustration makes sense. Watching a 40% drop in days is brutal. It doesn't matter if you believe in the long-term thesis. That kind of volatility tests your conviction. So here's what you need to ask yourself. Why did you buy it in the first place? Was it for a short-term trade? Or was it for strategic exposure? If it was strategic, if you bought it because you believe industrial demand is growing, because you believe governments are going to compete for supply, because you believe the paper market is fragile, then volatility is the admission ticket. It's the cost of being early. Your job isn't to panic every time price moves. Your job is to stay focused on whether the original thesis is intact. And from what I can see, nothing in the fundamental story has broken. What broke was leverage, and leverage always breaks eventually. The second type doesn't own silver and thinks this all sounds dramatic. If that's you, your skepticism is healthy. I actually respect that more than blind enthusiasm. You're watching from the outside and thinking, this seems like a lot of excitement over a volatile commodity. Maybe it is. But here's what I'd say. You don't have to act yet to learn. Start watching the spreads. Watch Shanghai versus New York. Watch what premiums do. Watch the policy language coming out of Washington or Brussels or Beijing. You don't have to buy an ounce to become informed. And if 6 months from now you see the same patterns I'm describing, you'll be ahead of most people who aren't paying attention at all. The third type trades actively and wants levels. You're not here for philosophy. You want to know where to watch, where to enter, where to exit. If that's you, here's what I'm looking at. For me, this is about structure. $88 to $90 holding midweek matters. If silver can hold that range, it tells me the rebound has real footing. It tells me there's support underneath from people who see value here. $95 to $100 is the breakout zone into Friday. That's where paper shorts start to feel pain. That's where you could see covering accelerate. And above 100, you're back into a zone where momentum can build. But here's the thing. Don't chase. If you missed the move from 70 to 90, don't FOMO into 95. Wait for confirmation. Wait for the market to show you it can hold these levels before you add risk. And for everyone, regardless of which type you are, here's the universal principle. When governments treat something as strategic, markets eventually follow, whether they want to or not. You saw it with oil in the 70s and 80s. You saw it with rare earths in the 2010s when China restricted exports. You're seeing it now with semiconductors and chips. When a resource becomes a national security concern, price is no longer just about supply and demand. It's about availability, access, and control. And silver is moving into that category. So here's what I want you to answer in the comments. Which type are you? Are you holding and feeling the whiplash? Are you skeptical and watching from the outside? Or are you actively trading and looking for entries? Let me know, because I want to understand who's in this community and what you're thinking. Now let me tell you where I stand personally. I'm not chasing tops and I'm not panic buying dips. I've been around long enough to know that emotion kills accounts. What I'm doing is watching signals. Let me tell you what I'm personally watching. First, I'm watching whether $88 to $90 holds through this week. If it does, that would tell me the low is in and we've established a new base. If it doesn't, if we see another flush down into the 70s, that would tell me the liquidation cycle isn't done yet and there's more pain to come. Second, I'm watching that $95 to $100 zone. If silver can break through that and hold it, especially going into the weekend, that would indicate momentum is shifting and shorts are covering. Third, I'm monitoring premiums on physical product. If those stay elevated at $10, $12, $15 over spot, the pressure doesn't go away. It tells me the paper market is still disconnected from physical reality. And fourth, I'm watching policy signals. If we see more announcements about stockpiling, about critical minerals, about supply chain security, That confirms governments are thinking strategically about this market. Based on my analysis, this move last week was mechanical, not emotional. It wasn't driven by a fundamental change in supply or demand. It was driven by margin pressure, leverage unwinding, and futures market mechanics. The fundamental picture hasn't changed. Industrial demand is still growing. Solar installations are still expanding. Defense budgets are still increasing. Governments are still talking about securing critical mineral supply. None of that went away when silver dropped from 120 to 70. What went away was leverage. And leverage always comes back once volatility settles. Now, I can't predict the future. I don't know if silver goes to 150 or back to 60. But I can tell you this. If history rhymes, and if governments follow through on even half of what they're signaling, the move that follows could be significant. Not because of hype, not because of manipulation theories, but because of structural supply and demand. When you combine growing industrial use with sovereign-level accumulation with a paper market that's overextended, you create conditions for a repricing event. And those events don't happen slowly. They happen fast. They happen when nobody's ready. They happen when skepticism is still high, and most people are still licking their wounds from the last drop. Let me give you one more thing to think about. This isn't just about silver. This is about learning to read market structure. It's about understanding the difference between price and value. It's about recognizing when a market is breaking for technical reasons versus fundamental reasons. If you can learn that skill, it applies to everything. Stocks, bonds, commodities, crypto, real estate. The principles are the same. When you see a violent move that doesn't match the underlying fundamentals, ask yourself what's driving it. Is it margin? Is it liquidation? Is it fear? Is it leverage unwinding? And then ask yourself if that changes the long-term story or if it's just noise. That's what I'm trying to teach you here. I'm not trying to tell you to buy silver. I'm not trying to hype you into a position. I'm trying to show you how to watch, how to interpret, how to think independently. Because at the end of the day, you're the one who has to make decisions with your own money. You're the one who has to live with the results. So do your own research, verify the data, look at the charts, read the policy statements, watch the premiums, and then make your own call. I'm not a financial advisor. This is not financial advice. This is market analysis and education. I'm sharing what I see, how I interpret it, and what I'm watching. You have to decide what's right for your situation, your risk tolerance, your goals. Don't ever let someone on YouTube tell you what to do with your money. Use content like this to inform yourself, but always think critically. If you made it this far, you're exactly the kind of person who's going to do well in markets over the long run. You're willing to go deep. You're willing to learn. You're not just looking for hot tips. You're trying to understand the mechanics. That mentality will serve you well, not just in silver, but in everything you trade or invest in. If this added value, share it with someone who's trying to understand what's happening in commodities right now. Hit the subscribe button if you want more breakdowns like this. And stay ahead of the noise by thinking for yourself and watching the data, not just the headlines. I'll see you in the next one. Stay sharp out there.